You opened the Roth IRA and felt smart, like you finally figured something out that most people haven't. Tax-free growth, tax-free withdrawals. You put money in, the government never touches it again, and somewhere in your 50s or 60s you pull it all out and pay nothing. You heard that and something clicked, you funded it. Maybe not the full limit, but something. And you told yourself you were ahead of the curve. But there's a number you haven't looked at. And when you do, the story changes. This is about that number. You've probably been told the Roth IRA is as close to perfect as the tax code gets. And in a narrow, technical sense, the people who told you that weren't lying. But they left out the part that turns the whole strategy against you, not because the account is bad, but because of what most people do with it, how they fund it when they fund it, and the assumptions they make about the future that the account quietly, invisibly exploits. The Roth IRA doesn't fail loudly, it fails slowly. It fails in the gap between what you thought you were building and what you actually built. And by the time you see it, you've spent 20 years optimizing for the wrong thing. But let's not start there. Let's start where you actually are. Think about the last time someone at work mentioned their Roth. The conversation has a specific texture. Someone says they maxed it out this year, and there's this subtle status exchange, like they passed a test. You either nod along or feel a quiet pang of something adjacent to guilt. Maybe you haven't maxed yours. Maybe you haven't started yet. Maybe you started and then life happened. The move, the kid, the car, the month that kept costing more than it should. And the contributions got paused, and then the pause became the default and you keep meaning to restart it, but the account just sits there. Or maybe you have been contributing faithfully every year. Whatever you can, sometimes the full $7,000, sometimes less. And you feel okay about it. You feel like you're doing the thing. Responsible future you is being taken care of. And you don't think too hard about what's inside the account, because thinking too hard about investing feels like a second job. You already have one. Here's what's probably inside it: a target date fund. Or a few ETFs you picked when you opened the account because the interface made you choose something before you could finish setting it up. Maybe a stock or two from a company you liked at the time. And it's grown, not impressively, maybe, but it's grown. The number is bigger than what you put in, and that feels like the point. It isn't. And this is where it starts getting uncomfortable. Because what you were never told about the Roth IRA is that the tax advantage, the thing that makes it supposedly superior to a traditional retirement account, is only valuable under very specific conditions. Conditions that most people never actually verify apply to them. You were sold the headline, tax-free in retirement. Nobody walked you through the fine print. Nobody asked you the question that determines whether the Roth is actually the right vehicle for you, or whether you've been leaving money on the table every single year by choosing it over the alternative. That question is, do you expect to be in a higher tax bracket in retirement than you are right now? Simple question. Almost nobody can answer it with any confidence. And that uncertainty, that gap between what you assume and what the math actually requires, is where the time bomb lives. Here's how it works. When you contribute to a Roth IRA, you pay taxes now on income you're earning today, and the account grows tax-free. The logic is, pay the tax when the rate is low, withdraw when the rate would have been high, and you win the spread. That's the entire thesis. That's why it's supposed to be smart. But if you contribute to a Roth in your peak earning years, when you're making more than you ever have, when you're in the highest bracket of your career, you are paying the highest possible tax rate on that money going in. And if your retirement income ends up lower than your working income, which is the case for most people, you've paid a premium tax rate for a benefit you didn't need. The traditional account would have been cheaper every year for decades. And what happens next is the part most people miss. There's a version of you, let's call him Daniel, who did everything the internet told him to do. He opened the Roth at 26, contributed every year, maxed it most years after 30, never touched it, let it compound, felt good about it at every annual review. By 55, he has $800,000 in a Roth IRA, tax-free. He's proud of it. He should be. It took discipline. But Daniel is also a high earner, has been since his mid-30s. In his peak years, he was in the 32% bracket. He paid 32 cents of every Roth dollar to the government before it ever entered the account. And in retirement, Daniel's income drops. Social Security, some withdrawals, maybe a part-time consulting thing. He ends up in the 22% bracket, maybe 24%. Which means he spent 30 years overpaying for a tax benefit he didn't need. The traditional IRA, pay at 22% on the way out instead of 32% on the way in, would have been worth tens of thousands more in total lifetime wealth. Maybe more than that. Nobody told Daniel to run the numbers. Nobody told him the Roth is a bet on your future tax rate, not a guaranteed win. But there's something darker underneath this. The hidden tax time bomb isn't just about bracket math, that's the surface layer. The deeper problem is what the Roth IRA mythology does to how you think about retirement planning overall. It gives you a destination and calls it a strategy. You're told, open Roth, contribute, invest, wait. And that's fine, it's not nothing, but it's also not a plan. It's an account, and an account is not a plan any more than a gym membership is fitness. The account is the vehicle. The question is where you're driving it, at what speed, on what road, toward what destination. And most people who have a Roth IRA have given almost no thought to those questions. They have the account and they have the feeling of doing the right thing, and they have almost no clarity about whether the doing the right thing is actually calibrated to their specific financial reality. Here's what nobody tells you about money: the tax code is not neutral. It was not written to benefit you equally regardless of your circumstances. It was written by people who understood money in a way most people never will, and it rewards, quietly, patiently, over decades, the people who understand how to use it and penalizes the people who follow general advice without understanding the underlying assumptions. The Roth IRA is a great example of this. In the right hands, for the right person, in the right earning phase of their life, it is genuinely powerful. For a 22-year-old in the 12% bracket putting money in that will grow for 40 years, extraordinary. For a 45-year-old in the 35% bracket maxing their Roth instead of their traditional 401k because they heard Roth is better? That advice is costing them money they will never get back. The wealthy don't think about tax-advantaged accounts the way you were taught to think about them. They think about tax arbitrage. They ask, when is my tax rate highest, and when will it be lowest, and how do I move income from the high point to the low point? That's it. That's the whole game, and sometimes that means Roth, and sometimes it means traditional pre-tax, and sometimes it means a combination that shifts based on your income that year, your bracket, your projections, your business structure if you have one. It's not one answer, it's a question you have to keep asking. And most people ask it once, at account opening, choose Roth because someone said it was the smart choice, and never ask it again for 30 years. Let that sit for a second. Here's the first principle. Tax-free is not always better than tax-deferred. The math depends entirely on when. The common belief is that paying taxes now and getting tax-free growth is obviously superior because tax rates will probably go up and you'll be glad you paid earlier. This argument sounds logical. It has a certain intuitive elegance, but it's speculative. You don't know what tax rates will be in 20 years. Nobody does, and the people making that argument are, in many cases, the people who sell Roth IRAs. What you do know is your tax rate today. If you're in the 10% or 12% bracket, pay now. Roth makes sense. The math strongly supports it. If you're in the 22% bracket, it's genuinely a toss-up depending on your projections. If you're in the 32% bracket or above, the traditional pre-tax account will, in most realistic retirement scenarios, cost you less total tax. Not because the Roth is bad, because the math, run honestly, doesn't support paying a 32% entry fee for a tax benefit you'll receive at a 22% exit. That's not wisdom, that's the appearance of wisdom. The identity shift this requires is going from I'm doing the right account to I'm doing the right math. And those are different people with different relationships to financial information. The first person feels good, the second person is actually building. And what happens next is the part most people miss. Here's the second principle. Your Roth IRA has a shadow problem called the contribution limit, and it's slowly making the strategy irrelevant. You can put $7,000 a year into a Roth IRA. That's the 2024 limit. For most people in their 30s and 40s who are actually trying to build retirement wealth, that number is laughably insufficient. To retire with any meaningful freedom, you likely need somewhere between $1 and $3 million, depending on your lifestyle. At $7,000 a year, invested at historical average returns, contributing from age 30 to 65, you're looking at somewhere around $1.1 million. That's fine, that's actually pretty good. But that's if you maxed it every single year without missing one. Most people don't. Life interrupts. The contribution drops 1 year, stops for 2 years, restarts inconsistently. And the gap between what you could have built and what you actually built widens quietly, steadily, in a way that's easy to ignore when you're not looking at a projection. But here's the real problem. $7,000 a year means you are capped. You hit the ceiling and you stop. And if your income grows, which is presumably the point, you eventually hit the income limit entirely and can't contribute directly at all. Above $161,000 for single filers, above $240,000 for married filing jointly, the Roth IRA contribution phases out. You can't even use it, and the workaround, the backdoor Roth conversion, requires its own set of conditions and a rule called the pro-rata rule that, if you have traditional IRA money anywhere, can create a tax situation that erases the benefit you were trying to capture. You were never told any of this when you opened the account. There's a person, let's call her Maya, who spent 12 years dutifully contributing to her Roth IRA while also building a small traditional IRA she rolled over from an old job. When she made enough money to need the backdoor Roth, her financial advisor at the time didn't mention the pro-rata rule, she did the conversion. The IRS treated a portion of it as taxable income because she had pre-tax money sitting in the traditional IRA. She owed taxes she wasn't expecting on money she thought was going to be tax-free. The Roth strategy, improperly implemented, generated a tax bill on the exact account she'd been told would protect her from taxes. This is not rare. This happens constantly. And it happens because people were told the Roth is good without being told the conditions under which it's good. This is where it gets interesting. Here's the third principle. The Roth IRA optimizes for the wrong kind of flexibility. You've probably heard that a Roth IRA is the most flexible retirement account because you can withdraw your contributions, not earnings, but contributions, at any time without penalty. That's true. And it's often used as a selling point, your emergency fund and your retirement fund in one place. A safety net that also grows. It sounds efficient. It is, in practice, one of the most dangerous features of the account, because the moment your Roth IRA becomes mentally available for non-retirement purposes, it stops functioning as a retirement account. You start counting it in your accessible money. You think about it differently. The withdrawal option creates a psychological permission structure that slowly erodes the account's intended purpose. The people who retire with the most money are not the people who had the most flexible accounts. They're the people who made their retirement money untouchable, not by law, but by identity. They decided that money was gone. It didn't exist. It would show up at 62. The flexibility of the Roth, for many people, is not a feature, it's a leak. And here's what that reveals about the deeper problem. The Roth IRA, as it's commonly taught and commonly used, serves the feeling of financial responsibility more than the reality of it. It's the account you open to feel like you're handling your future. And feeling like you're handling it is not the same as actually handling it. The people who build genuine wealth are ruthlessly unromantic about their accounts. They don't have emotional relationships with account types. They ask, given my income, my bracket, my timeline, my other assets, my business structure, my estate planning goals, what is the most efficient way to move money from now to later while minimizing what the government takes? And then they build accordingly, and they revisit the question every time something meaningful changes. That is a completely different posture than I opened a Roth and I feel good about it. Your lifestyle is someone else's marketing budget working. You've heard that and you thought it was about spending. It's also about how you think about financial products. The Roth IRA has one of the best marketing campaigns in personal finance history. Tax-free, simple, good for everyone. Endorsed by influencers, mentioned in every beginner personal finance list, described as close to a free lunch in the tax code. And the people who benefit most from you having a Roth IRA are not necessarily you. They're the financial institutions that hold the account. The more accounts, the more assets under management, the more fees, even small ones you don't notice, the more business. The advice that's everywhere isn't always the advice that's optimal. It's often the advice that's easiest to explain and easiest to sell. Nobody told you that. You were busy trying to figure out retirement. You took the shortcut that sounded smart and kept moving. Project it forward. If you've been contributing to a Roth in your peak earning years and you retire with the income profile most people retire with, lower than your working income, Social Security as a significant component, maybe a pension, maybe investment withdrawals, you will have paid the highest tax rates of your life on money going into an account that will be taxed at the lowest rates of your life on the way out. That is the opposite of tax optimization. That is the Roth time bomb, not an explosion, a slow leak. 30 years of small misdirections compounding into an outcome that's meaningfully worse than it needed to be. And you'll never be shown a receipt for what it cost you. You'll just have a number that's lower than it should have been and no clear explanation for why. 5 years from now, you'll wish you had looked at this earlier. 10 years from now, the cost will be measurable in tens of thousands. That's not fear. That's the math running quietly in the background whether you look at it or not. Most people can't bring themselves to examine this closely. It requires admitting that the thing they felt smart about might not have been as smart as it felt. And that discomfort, the specific sting of well-intentioned financial decisions that turned out to be suboptimal, is harder to sit with than the discomfort of never having started. Because at least if you never started, you know why you're behind. When you did everything right and you're still behind, the confusion is worse. But some people look at the math honestly, they don't spiral. They don't feel like failures, they just adjust. They ask, what is the right vehicle for my situation right now? They run the bracket comparison, they talk to someone who can model both scenarios. They make the shift from following general advice to executing personalized strategy. And the adjustment, even made late, even made at 45 or 50, still matters. The compounding clock is slower, but it's still running. What you do in the next 5 years will still shape the decade after that. It is still worth getting right, so here's where you are. You have two paths, and neither one is entirely comfortable, so let go of the idea that one of them is the easy option. The first path is continuation. Keep contributing to the Roth the way you have been. Keep feeling the mild satisfaction of doing something for future you. Don't look too closely at the bracket math. Don't model the alternative. Don't ask whether the account you chose at 28 is still the right account for who you are at 42. The anxiety will stay low. The account will grow, and somewhere down the line, you'll have a number that's good enough to mostly work. Probably in a set of circumstances you're hoping will align with the assumptions you made decades earlier. That's a lot of hope riding on a lot of variables you never examined. The second path requires you to treat your retirement accounts the way people who actually retire well treat them, as instruments, not identities. It means looking at your bracket, looking at your projected retirement income, comparing the math of paying taxes now versus paying them later. It means possibly shifting some contributions from Roth to traditional if the numbers support it. It means understanding the pro-rata rule before you do another backdoor conversion. It means asking whether $7,000 a year is even close to enough, and if not, what other vehicles exist, what their trade-offs are, and how they fit your specific picture. That question, your specific picture, is the one you've been avoiding. Not because you're avoidant, because nobody ever asked you to have one. General advice doesn't require a specific picture, it requires a general action. And general actions, executed over decades, produce general results. Which is usually fine, unless you actually want more than fine. The Roth IRA is not the enemy. The enemy is the gap between what you think you're doing and what the math says you're doing. Close that gap and the account becomes a tool again. Leave it open and the account stays a story, a reassuring one, told quietly to yourself every time you check the balance and feel that small, warm sense of having handled something. You handled something. The question is whether you handled it well. Not if you can find out. You can. The question is whether you'll look.